It was the 19th of June 2025 when Uffizi Holdings, a Minecraft-based hedge fund, was dramatically taken off the stock market in a Minecraft server known as Democracycraft. With a market value of 114 million Democracycraft dollars, that's $46,300 at the rate people were buying and selling the currency for, Uffizi Holdings was the crown jewel of the server's stock market. With a legendary CEO at its helm, and with an impressive track record investing in anything a Minecraft company feasibly could, real estate, mining companies, supermarkets, and derivatives to name a few, Uffizi Holdings quickly became the go-to destination for new players and government officials alike to stash their virtual savings into. By January 2025, Uffizi Holdings had become one of the indisputable titans of Democracycraft's over $100,000 financial industry, a towering symbol of the Minecraft server's 3-year economic boom. But something had gone terribly wrong since then. The company's accounting records, which it had been providing to shareholders and investors, hadn't been calculated properly. A rapid review of the company's finances revealed it had incorrectly recorded its own stocks as assets, things it owned, meaning that the company overstated how much it was worth to shareholders and investors. Perhaps these accounting errors could have been written off as being not that big of a deal, were it not for the fact that just a few days prior, Vanguard National Bank, its main rival, had spectacularly collapsed in what could possibly be the largest bankruptcy case in Minecraft history, defaulting on over $39,000 worth of debts it had no way of ever paying back. The server's investors were in a jittery mood. If the media caught wind of Uffizi Holdings' so-called accounting discrepancies, there was no doubt in anyone's mind about what would happen next. Mass panic selling of Uffizi Holdings stock, tanking its share price, and very likely tanking the share prices of other companies as well. A complete collapse of Democracycraft's stock market, taking over $83,000 worth of virtual stocks down with it. Something had to be done. So, in the early hours of June 19th, 2025, the executive decision was made. The stock market was booting out Uffizi Holdings. A new player, Stoppers, was installed as Uffizi's new CEO, and his job was to stabilise the company's finances and to get its paperwork in order. Once the initial panic from Vanguard's bankruptcy had subsided, Uffizi Holdings could then be relisted in the stock exchange as if nothing had happened. 1 week later, Uffizi Holdings published its second set of accounts, with all of its accounting discrepancies rectified. The company owned $2,900 worth of assets. The company owed $18,700 in debt. Crunching the numbers, it meant that the company was worth a grand total of minus $15,900. Uffizi Holdings was utterly insolvent. Being $15,900 in the red for a Minecraft server is probably not the most prudent investment you could make with that amount of money. With $15,900, you could buy 141 discounted copies of The 4 Illustrated Survival Guide by this video's sponsor, Off Protocol. Off Protocol is the creative team behind storytelling products that blur the line between art, science, and chaos, and the 4 book is their latest project that takes you through 4 very realistic scenarios for how the world could be turned into an apocalyptic hell, that being a pandemic, global warming, nuclear winter, and of course, zombie outbreak. Having raised over $500,000 US on Kickstarter alone, this gargantuan 400-page hardcover book is filled page to page with stunning, hand-drawn, non-AI generated artwork. But the thing that surprised me the most was just how sturdy the actual book is. Like, just listen to this. That's the sound of not just a book, but a weapon that you could use to bludgeon zombies with by smashing their skulls into tiny, tiny pieces. This actually isn't mentioned in the book, by the way, so you're welcome for that extra tip. In the unlikely event that the world hasn't succumbed to total systems collapse though, the book still makes for a nice gift, a coffee table collectible that is bound to spark conversations, especially if you display all 141 of them. Check out the link in the description below and use the promo code Trolley4Book for a 20% discount on your copy of The Four Illustrated Survival Guide. By the time he founded Uffizi Holdings in 2023, Super had already gained a reputation as a veteran within Democracy Craft's financial sector. Starting with just $4 worth of virtual currency, if he's to be believed anyway, Super quickly grew his company out of basically nothing. Hamilton City Bank, as it would later be known, would hit a peak valuation of $600 by December 2021, making so much money that it was reportedly paying out over $40 of interest payments to its customers every single month. The main way that Hamilton City Bank made its money was by buying and selling shares on the server stock market, which had been going up and up for close to a year. Players across the server invested their savings into some of the Minecraft server's fastest growing companies. You had supermarket chains like Walmart and Walgreens, which sold everything from sea lanterns to elytras. You had wholesalers like Costco, which hired, independently contracted, legions of underpaid kids to mine diamonds and log trees to sell in bulk. You had massive conglomerates like Onyx Industries, which, according to its CEO, was the first major company to use villagers at an efficient rate, making most of its money by selling enchanted books to consumers. Hamilton City Bank was all in on the stock market, pouring over $140 worth of virtual currency into business stocks. When a short seller in January 2022 approached Super with a bet that the entire stock market was going to crash within the next 3 months, Super immediately took him up on the offer. You want to bet against the entire stock market, which has done nothing but go up in the past year? I mean, sure, if you're going to give us free money, we're going to take it. The deal they struck was this. The short seller would pay $4 to the bank every week until March 2022. If the stock market dropped below 2.6% of its original value in January, the bank would pay out a penalty. The larger the drop, the bigger the penalty. The stock market didn't drop by 2.6%, 3%, or even 3.4% though. It dropped by 11.5%, following media reports of troubles, and maybe even fraud, related to the running of the stock market. That 11.5% drop meant that the Minecraft bank, worth roughly $600, was left with an estimated bill of $923.26. Not all hope was lost though. After begrudgingly settling the case out of court, which saw the bank agree to pay $366 in 6 monthly installments, the bank struck a different deal with the Redmont People's Trust, RPT, a different bank. They would merge, forming a new bank called the Tello Corporation. Now, obviously, there were some concerns on the RPT end about whether it was a good idea to inherit $366 of debt, but the co-CEOs of Hamilton City Bank were relentlessly optimistic. $366 of debt was $61 a month? All the newly formed bank needed to do was make more than $61 a month, and everything would be fine. They'd pay back their debt, they'd make even more money than if they stayed as separate banks, and they'd go home stinking rich. This was clearly a great deal for both banks, not just for Hamilton. So, as Super slowly drifted into the background, and as Tello burst into flames trying to pay back the $366 debt that was wrecking its finances, Super began to reflect on the lessons he learnt from his previous ventures. Firstly, risking it all on one big trade was a terrible investment strategy. Hamilton City Bank had already made a massive bet on the stock market going up. Doubling down and betting even more money was ultimately what killed it. For a financial institution to succeed, it can't have a single point of failure. It needed to have diversification. It needed to have multiple ways of making money. Secondly, M&A, mergers and acquisitions, was seemingly a great way to grow a business. He started off with a small company, IBC, which merged with another to create Icarus Bank, which merged with another to create Hamilton, which merged with another to create Tello. Every step of the way, the value of his company got bigger. First, it was $4, then it was $81, then it was $600, and finally, it was $1,300. And sure, Tello ended up collapsing, but that was arguably more to do with poor execution than poor strategy. Perhaps he had it all figured out. When Super burst back into the spotlight in July 2023, he offered prospecting investors a bold new proposition, a chance to invest in his brand new hedge fund, Uffizi Holdings. At the core of his company's philosophy was diversification. He wasn't going to put all of his eggs in one basket. Putting his own money on the line, Uffizi Holdings had already acquired several smaller businesses, known as subsidiaries. Omni General, for instance, was your typical supermarket chain where players bought groceries, creeper eggs, and firearms. Axel Construction was who you called if you needed house builders, interior designers, or demolition experts. Uffizi Finance was just your ordinary bank, offering stuff like mortgages for players wanting to buy their new Minecraft home. On the 10th of July 2023, Uffizi Holdings was listed on the stock exchange, allowing ordinary players to buy Uffizi stock for the very first time. But why would Super return to the stock market, considering what had happened there last time? Expanding a business costs money. Land costs money, building materials cost money, and employees cost money. Buying out entire businesses like Uffizi Holdings certainly costs money. So how do businesses get money? Well, the most straightforward way is to make a profit. If the amount of money a supermarket makes is more than the money it's spending to run itself, it's making a profit. The supermarket could gradually save up those profits it's making so that it can set up new locations in the future. But this process can be really, really slow, particularly if the profit being made isn't actually that much. So how do we speed up the process? How do we get the money to expand now? If the CEO is a smooth talker, maybe they could convince a bank to give them a small loan of $1 million. If they're sufficiently well connected, maybe they could get a friendly congresswoman to slip in a couple $100,000 in their next budget bill. But another way of doing things would be for them to sell shares of their company on the stock market. By selling, let's say, 40% of their company, they could get a lot of money really quickly from the shareholders who had just bought those shares. They'd be giving up 40% of their company away, but in return, they'd receive a massive cash injection, which would be enough to quickly expand the company. Their slice of the pie may be smaller, but the total size of the pie, at least in theory, got bigger. But how would an investor know how much they should be buying those shares for? This is where disclosure rules come in. Stock markets, both in Minecraft and real life, have rules requiring companies listed on them to regularly give information about how their companies are doing financially. Income statements, for example, tell us how much profit or loss a company has made over a period of time, let's say a month. Balance sheets, on the other hand, tell us how much stuff a company owns, how much debt a company owes, and how much shareholders would have left if the company were to be theoretically dissolved. With his company's finances in hand, Super made his pitch. Uffizi Holdings was already a successful company. With his own money, he built up a hedge fund with profitable subsidiaries across the board. His supermarket made money, his bank made money, his construction company made money. But Uffizi Holdings was capable of so much more. Super only had so much money to pour into his hedge fund. If ordinary players chipped in their pocket money and bought some Uffizi stock, he'd be able to raise enough money to aggressively expand his company. He'd be able to buy out real estate companies, insurance companies, and luxury brands, just to name a few. His pitch worked wonders, and Uffizi's stock price began to rise. On the day Uffizi Holdings made its debut, investors valued the company at around $111. In less than 2 months, the company had grown by a whopping 250%, reaching a valuation of $390. After doing a bit of corporate rejigging, which technically involved selling off the company and starting a new spiritual successor called RWE Capital, the name is going to change a lot, so I'll continue calling it Uffizi Holdings, Super went on a shopping spree, buying practically everything his hands could touch. He bought lots of real estate, packaging them as real estate investment trusts. He bought lots of debt from other banks, selling them as multi-level reduced-risk credit-backed security groupings, or Malurkubiskas for short. He of course bought stocks in a lot of other companies as well. And some of the things Super bought were admittedly duds. In May 2024, his company bought a 50% stake in a bank called Artrides. That bank collapsed just 1 month later. According to court filings, its CEO, the only person with access to the bank's vaults, suddenly stopped playing on the server. This meant that the bank's customers couldn't withdraw their money, leading to its collapse. But honestly, this was to be expected. When you're investing in so many different companies, sectors, and industries, you're bound to have a few that don't pan out. The whole point of Uffizi's strategy, diversification, was for the company not to be reliant on any one investment. Even if some made losses, the others could make up for it. His shareholders were similarly unfazed by these setbacks, who rewarded the company by buying even more of its stock at higher prices. In April 2024, the stock market valued Uffizi Holdings at $451. Just 3 months later, that same market valued the company at over $4,000. Super's strategy seemed to be working perfectly. Uffizi Holdings was growing at a rapid rate. But Super wasn't done yet, because there were more things left to buy. He, at this point, had set his sights on buying a very different type of company: his competitors. The rapid rise of Uffizi Holdings had demonstrated to Democracy Graph's business leaders that its player base craved investments. Players, chock full of virtual cash, wanted a place where they could safely stash their savings. What helped a lot was that the political establishment was on their side. Politicians, ever keen to present themselves as pro-business and pro-growth, greenlit massive tax breaks for banks, hedge funds, and other financial institutions. The only thing better than a hedge fund was one that was tax-free. It didn't take long for Uffizi Holdings to attract new competitors, including S Capital and the Sigma Strategies Corporation. Nor did it take long for other companies to pivot their strategies to copy what they thought was driving Uffizi Holdings' success: buying everything. Democracy Craft was soon gripped by M&A mania. Whichever company bought or owned the most subsidiaries was, by extension, the most diverse company. The most diverse company was, by extension, the safest company to invest in. And so everyone began jumping on the M&A bandwagon. Virtus Group, for instance, a self-described media and entertainment company, began showing off to investors the ludicrous number of subsidiaries it owned. It claimed to own an events organising company, 2 betting companies, 6 news outlets, a business ratings agency, a financial media outlet, the UFC, not the real one, a film production studio, a luxury holiday resort, an entire theme park called Virtusland, a football league, an art gallery and studio, an alcoholic beverage company, and even a space company? Acquiring Uffizi's rivals seemed like the natural next step. With diverse investment portfolios of their own, Buying them out wouldn't risk putting Uffizi's eggs in one basket. Rather, it would simply add more eggs to it. After a bit of negotiation, S Capital and Uffizi Holdings agreed to tie the knot, and when two became one, Uffizi's share price jumped even higher, reaching over 20 million democracy craft dollars, or $8,440. The market had proven it wanted bigger and bigger companies, and Super's appetite grew even larger. When Super approached the Sigma Strategies CEO with an offer to merge the two, however, he was immediately rebuffed. No way, Admin23 responded. The SSC was not for sale. Under his leadership, the SSC had become a giant in its own right. It had its own line of subsidiaries. It had its own trading strategy. It had its own war chest filled with cash and netherite ingots. The SSC was operating fine on its own. It didn't need to join Uffizi Holdings' umbrella. But this was where we saw the ruthless determination that Super had to acquire his rivals. Because if the Sigma Strategies CEO wasn't willing to budge, fine, he was going to go around him. Super was going to mount a hostile takeover. A hostile takeover is when one company takes over another company without the other management's permission. This is possible because the final say over what a company does generally rests with the shareholders and not the company's CEO. Thus, if a company's CEO objects to a takeover, but a majority of shareholders agree to one, the takeover still happens because the shareholders overrule the CEO. Admin23 set up his company so that there were actually two types of shares, Class A and Class B. Class A shares, of which there were 100 in total, gave a person one vote per share. Class B shares, of which there were 10,000 in total, gave a person 1/200th of a vote per share. Altogether, that meant there were 150 votes on the table, with 76 giving you a majority. Admin23, quite wisely you could say, kept most of the Class A shares, giving him sizable voting power. Most of the SSC shares sold on the stock market were the Class B type, the cheaper and far less powerful type. But somewhere along the line, Admin23 sold a third of the company's Class A shares. Those shares were acquired by a different company called The Exchange, the company that ran the stock market. That meant that Admin23 no longer had majority control of the company. If all of the shareholders theoretically joined forces, they could outvote the CEO. Super, through his company Uffizi Holdings and its subsidiary S Capital, began gradually buying more and more Class B shares. By late September 2024, Super had acquired over 7,000 Class B shares, giving him 35 votes. By joining forces with Stoppers, who was the CEO of the exchange, they possessed 81 out of 150 votes. They had majority control. The takeover of the SSC was as swift as it was brutal. Despite admin's protests that the vote was illegal, on the 20th of September 2024, the shareholders of the SSC voted to sack Admin23 and install Super as its new CEO. With the chief more amenable to a merger with Uffizi Holdings, the two tied the knot on the 11th of December 2024. Uffizi Holdings was now the indisputable king of Democracy Craft's hedge funds. With no investment firms considered its equal, the hype train surrounding its share price went full steam ahead. In February 2025, its market value was at 40 million Democracy Craft dollars, nearly 16,400 US. In March, it jumped to $61 million, 24,800 US. In April, it sat at $85.5 million, 34,800 US. And by June 2025, it was at $114 million, 46,000 US. Large parts of the server were now riding on the Uffizi hype train. The F10K index, for example, a fund that was set up to allow players and businesses to invest in a diverse group of companies, suddenly found itself being composed of 55% Uffizi stock by February 2025. 1 month later, when Virtus Group declared bankruptcy, the F10K's composition became 86% Uffizi Holdings stock. Even the government was getting involved. The Federal Reserve Bank, the body tasked with keeping the server's inflation under control, began pouring millions of democracy craft dollars into buying Uffizi Holdings stock. By the end of January 2025, 90% of the stocks it owned were in Uffizi, representing 24 million democracy craft dollars, or $9,750. Questions at this point had begun to swirl. How could a Minecraft company be worth so much? As investors began to question Uffizi Holdings' ever-growing share price, Super sought to disabuse them of their concerns. The company's accounting records showed that it was making gigantic profits. Between January and April 2025, the company's balance sheets suggested it made over 34.8 million democracy craft dollars, or $14,200. The claim was remarkable. Just 2 years ago, the company was boasting about how its supermarket chain, Omni General, was raking in the equivalent of $1 a day. Now, it was casually claiming it had made over $4,700 a month in profit. And it wasn't clear where these profits were coming from. In the past, Uffizi Holdings made a lot of its money from the profits generated by its subsidiaries, but those subsidiaries no longer existed. Omni General no longer existed. Red Rocket no longer existed. Uffizi Finance, Apollo Bank, Megacorp, Axel Construction, Rolex, Heritage Property Group, Airbnb, Union Bank, Titan Risk Management. None of those subsidiaries existed anymore. Many of them, after all, were previously one-man companies run by their owners. The owners did the heavy lifting. They opened up stores, they stacked up shelves, they negotiated with suppliers. When Uffizi Holdings bought out these companies, giving their owners a hefty sum of cash and some Uffizi stock, what did they do? They moved on, taking their labour and expertise with them. After Uffizi Holdings finalised its takeover of the SSC, for instance, something curious happened. All of the SSC's subsidiaries simultaneously collapsed. Why should Admin23 continue to run Airbnb, Union Bank and Titan Risk Management if all of their profits were going to Uffizi Holdings anyway? Why should he continue to run the SSC's trading division, which he previously made huge profits for, to benefit the very people who ousted him as CEO? If Uffizi Holdings was this determined to take over his company, fine then. Have fun running those subsidiaries without the only guy who has previously run them. So, if it wasn't Uffizi's subsidiaries that were making it this much money, what was? By June 2025, we had our answer. It was due to a quote-unquote accounting discrepancy. As mentioned before, a balance sheet provides crucial information about a company's finances. Specifically, it tells us what a company owns, its assets, what a company owes, its liabilities, and what shareholders would have left if the company closed its doors, its shareholder equity. So, suppose I had a balance sheet for my very legitimate TNT company. This is what it could look like. First, we have the assets, things we own, so stuff like cash, items, real estate, and the stocks of other companies. Then we have the liabilities, things we owe, so stuff like loans taken out from private banks. Finally, we have the shareholder equity, what's left, which, if calculated correctly, should be equal to the assets minus the liabilities. What if my company bought back some of its own shares? Perhaps I thought my company's share price was too low, and by doing a stock buyback, I'd be able to push the price up by reducing supply. How would I record that on the balance sheet? Perhaps the intuition would be to record it as an asset. After all, if the shares of other companies count as assets, why would the shares of my own company, also known as treasury stock, not be? The answer, however, is that it isn't an asset. As the former Finance Minister Sink pointed out, treasury stock should be recorded as a subtraction of shareholder equity, or to use the fancy term, a contra equity account. To understand what on earth that even means, and to get a basic feel for why this is the case, let's use a simpler example. Suppose I created a new company and issued 100 shares for $1 each, meaning one share gave you 1% of the company. A balance sheet for the company would look something like this. Assets, we have $100 in cash, so $100 in total. Liabilities, we took on no debt, so $0 in total. Shareholder equity is generally split into two sections. Paid in capital simply means the initial amount of money we raised when selling our shares, so $100, and retained earnings is how much profit the company has earned since then. 0, since the company hasn't done anything yet. Checking our work, assets minus liabilities equals shareholder equity. $100 minus $0 equals $100. The maths checks out. Now, suppose the company buys back 99 of its shares for $1 each, with the final share being held by me. If we incorrectly record these shares as assets, our balance sheet would look something like this. Assets, we have $1 in cash and $99 in stocks, $100. Liabilities, no debt, $0. Shareholder equity, paid in capital is the same, retained earnings are the same. $100 minus $0 is $100. The maths also seems to check out. Well, the company is still worth $100. So let's dissolve the company. I own one share, so I should get 1% of what's left, and the company owns 99% of itself, so it gets 99%? But the company obviously won't exist anymore, since it's been dissolved, so if we only count shares held by valid people, I own 1 out of 1 share. In other words, I should get 100% of what's left. That's great, so let's work out the payout. I get $1 in cash, and 99 shares of a company that no longer exists. On paper, they were worth $99, but in practice, they're completely worthless. If we total up what I actually got, I only got $1. The accounting completely breaks apart. Had we accurately recorded the treasury stocks as a subtraction of equity instead, we would have seen what was happening in reality. Assets, we had $1 in cash, treasury stocks don't count. Liabilities, 0 debt, $0. Shareholder equity, paid in capital is the same, retained earnings are the same. Crucially, however, we add one more section, treasury stock, minus $99. $1 minus $0 is $1. The company is thus worth $1. Notice how the accounting breaks apart though. While my company only had $1 in assets, it was misreporting it had $100. To put it another way, misrecording a company's treasury stocks overinflates the company's assets on paper. This overinflation makes the company look like it's worth a lot more than it actually is. And this problem can quickly snowball out of control because share prices can increase. Suppose I convinced a player to buy my singular share in this company for $2. What happens now? Well, if we go back to the balance sheet, the company's stocks aren't worth 99 times $1 anymore. They're worth 99 times $2, or $198. With that one share price increase, my $1 company is now worth $199 on paper. Now, suppose this player sells their share for $3. What now? 99 times $3 equals $297. Plus 1 gives me $298. It's a self-reinforcing cycle. Every time the company's share price increases, the company's book value increases. Every time the book value increases, the share price increases because investors are willing to pay high prices for what they perceive to be a rapidly growing company. But in reality, nothing has changed. The company is still worth $1. The accounting error was subtle at first. The occasional stock buyback here and there meant most of Uffizi's reported assets were still in other things. But every time it did another round of stock buybacks, every time it acquired another competitor that owned Uffizi stock, the company acquired more and more of itself. By June 2025, the error had become too big to ignore. Something was clearly wrong with the company's accounts. When the error was identified and its accounts were revised, the extent of the damage was revealed. Uffizi Holdings' assets were overvalued by an estimated 73 million democracy craft dollars, or $29,700. $30,000 had never existed in the first place. When stoppers wrestled full control of the company, buying out everyone's shares at its overinflated share price, it was far too late. Uffizi Holdings had taken on way more debt than it could ever pay back. The loans it took were predicated on the assumption that it owned more assets than it did in reality. The only thing that was still earning Uffizi money was its subsidiary, Volt Bank, the second largest bank on the server. But the crippling levels of debt Uffizi held threatened to sink it to the ground, potentially collapsing another bank at a time when the server faced its Lehman moment. The painful decision was made. Uffizi Holdings was to sell Volt Bank. If the parent company couldn't survive, the only hope was for their beloved child to live on. On the 30th of June 2025, Uffizi Holdings submitted its final balance sheet. The company owned $2,900 worth of assets. The company owed $18,700 in debt. Crunching the numbers, it meant that the company was worth a grand total of minus $15,900. Uffizi Holdings was utterly insolvent.